We'll start.
Okay.
Hello and welcome to Trust Mutual Fund's monthly market thesis webinar, where our experts share their insights on the markets and do a deep dive on our funds. I'm Vibhuti, Zonal Head North. I am joined by our CIO, Mr. Mihir Vora. Today, Mihir will be taking us through the concept of guerrilla investing in detail and will be sharing his outlook on the markets, apart from covering Trust Mutual Fund's existing equity funds positioning. If you have any questions, you can post them during the webinar in the comment box. We will take it up at the end of the session. Over to you, Mihir.
Thank you, Vibhuti, and welcome everybody. Always a pleasure to meet up with all of you on a monthly basis. So since we just completed 1 year for our Flexi Cap Fund, and of course our small cap funds also almost crossed 1,000 crores, we thought, since some of the partners might be new, spend a few minutes refreshing our investment philosophy, because when we launched the previous funds, we had spent a lot of time in trying to explain our investment approach and our investment philosophy. So some of you might already be aware of it, but there are a lot of new partners who have joined us later. So for the benefit of the group, I thought just spend 5-10 minutes on explaining the terminal value investment philosophy, which is what we try to implement in our style of, as I would say, growth investing. So, just to kind of refresh where we come from, Trust Mutual Fund basically follows the prism of terminal value investing or growth investing. And basically, investing is in our DNA as a group, basically, given the background of the promoters, which all of you know. But ultimately, it's our wisdom which gives us the secret sauce, which is terminal value investing using differentiated insights. Our approach to investments is growth at reasonable valuations, but with terminal value as the valuation methodology when we are trying to evaluate the future growth potential, right? So what is the concept of terminal value investing? And what is the concept of gorilla investing? So the whole concept can be, summed up in an example which I will just run you through. But essentially, as an investor, as an analyst, as a fund manager, or as a layman, it is relatively easy to predict the near term. So if a company has grown profits at a certain rate for the last few years, it's natural to assume that similar growth rates or a little higher or a little lower will continue for the next few years, 1, 2, 3 years. And, try to see what the profits can be after 1 or 2 or 3 years. So that's, not that easy, but relatively easier because companies give results on a quarterly basis. They do conference calls. They come on TV and give some guidance, etc. So we can try to figure out what's going to happen in the next 1 or 2 or 3 years. But what happens is that it's kind of very difficult to predict the longer term. So if you ask the same management or the same analyst or the same fund manager what the company will do after 5 years or 10 years or 15 years, then it becomes more and more uncertain. It's difficult to predict. It's natural to act that way. The point is that markets are much, much smarter than the individual wisdom. The wisdom of the markets, the way the market looks at stocks and sectors and segments, as an aggregate, market is millions of people buying and selling on a daily basis. So the value that the stock is deriving today is from the decisions of those millions of investors. So the wisdom of the markets on an aggregate basis is far more sometimes, forward-looking compared to the wisdom of the individual. So one fund manager, one analyst, one investor taking a call on a stock and trying to say this is the value of a stock, in my opinion, it can be dramatically different from what the collective market participants are doing. So the whole concept of terminal value is basically to accept the fact that in high growth stocks and sectors, and I want to underline the fact that this is more applicable to high growth stocks and sectors. And India is, of course, a high growth market. So the main point of terminal value investing is that in high growth stocks and sectors, markets and investors tend to grossly underestimate the terminal value, the long term value for high growth stocks. And what is terminal value? Terminal value is the value of a company which is derived from the profits of the longer term, not the profits of the next 1 or 2 or 3 or 4 years. The profits that the market thinks that the company can generate after 5 years, after 10 years, 15 years down the line, 20 years down the line. The market is already looking at all those profits in the future and seeing what growth the company will achieve in 10 years, 15 years, and arriving at the value of a company. This is very difficult for individuals to do, but the market is already doing it. So the point is, for high growth stocks and sectors, whether you are able to take a call on the longer term profit potential of a company or not, the market is already taking a call. And it's for you to figure out what the market is doing, what the market is thinking, and see whether you agree with the market's assumptions. So for high growth stocks and sectors, the approach of terminal value investing helps us to identify the true potential of a growth stock. It helps us to capture the full value creation journey by staying invested for the longer term. Now, the point is, I'll give you an example. It's easier to understand it through an example. Uh, so this is the largest jewelry company in India. No prizes for guessing which company we are talking about, floated by one of the most respected business houses in the country. Uh, so if you look at a normal analyst, this was a known company, well-known company 20 years back. So it was not an unknown company. It was an established company which had pivoted from watch manufacturing to jewelry manufacturing and jewelry retailing and distribution and branding and product development. So the transition, of course, took a few years, but by 2004, 5, 6, the company had already made that pivot to being a jewelry company, and it was growing very fast, and it was growing at almost 30% plus at that point in time in 2006. So if I look at the past few years in 2006, so what the company did in 2003, 4 or 5 or 6 or 7, it was growing at about 30, 35, even more than that percentage. So what a normal analyst would do is that he or she would project similar growth rate for the next 1, 2, 3, 4 years. And as the predictions for the fifth, sixth, seventh, eighth, ninth, 10th year kind of come, you typically want to become conservative. So if I'm growing at 35% for the next 3 years, analyst or fund manager typically would say that 35% may not be sustainable. It will slow down. So it will go down to 30, 25, 20, 15. And typically after 10 years, people tend to take a nominal GDP growth or a nominal valuation of 5, 7, 10% kind of a growth beyond the 10th year. So by using that model, if I were to look at the profits of that company in 2006, the actual profits were about 80 crores. But by using that model of 35, 20, 20, 35, 25, 20, etc., which is of course a very growth rate, high growth rate. So means even for the 5, 7, 8 years, it is still growing at 20% and all that. But even that, if you compound that, the profits would have grown at this rate. So it would have they would have gone up by almost 10 times by 10 years, and the profits would have been about 1,300 crores. From 80 crores, a very healthy jump, almost a 15x jump, so to say, in about 18, 20 years. So this is what even an optimistic analyst would have predicted. But what happened in real life? In real life, the profits grew from 80 crores to almost 3,000 crores in 2023, and probably it will be close to 4,000 crores into FY 25-26. So the point is that the profits did not stop growing at less than 25%. Even after 5, 10 years, the profit continued to grow at a high rate, of 24.3% CAGR from 2006 to 2023. What we would have assumed would be a CAGR of probably, maybe 15 to 17% by this logic. which is also a very healthy number. Very few companies are able to do this. But the actual company managed to grow profits exponentially by 40x almost, between 2006 and 2025, or 50x by 2025, because right now it's closer to 4,000 crores. So we would have expected 18% CAGR. So this trajectory that I showed you is about 18% CAGR, right? But the actual trajectory, which is this, is about 24.3% CAGR. This is what is the difference in reality versus perception in a high growth stock. What happened to the stock price? Yeah, we saw this. The profits went up by 40 to 50 times. We expected the profit to go up by 15 times, but it actually becomes 40 to 50 times, 50 times. If we had given a normal price to earnings ratio of about 20x to those profits of expected profits, the expected profits were 1,300 crores. This is the profit I'm talking about. And if you had given a normal market P of 20x, the market cap would have been 27,000 crores, right? But in real life, it would have gone up from 3,700 crores to 2,700 crores, almost 8x, right? We would have expected. But in real life, the stock price went up by 60x because the profits went up by 50x almost, right? So 59x is the stock price appreciation, a CAGR of 27%. Remember, the profits grew at 24% and the stock price grew at 27%. So in the long term, the stock price will mirror profit growth. Mota moti, in the long term, the value creation typically comes from profit growth, much less because of value creation. So the market cap created from 2006 to 2023, extra market cap creation, two-thirds of the market cap creation, 66% came because of profit growth, right? And one-third of it came from valuation change. So valuations did go up, and typically when the company does so well for so long, valuations do go up, and that's the reason why the stock gets re-rated. But bulk of it, 60-70% of the change in the market cap, the change in the appreciation in the stock price, came because of value creation, but because of profit growth. So this is the level of underestimation that people can do when you talk about high growth stocks and sectors. So that's why the value of these profits. So if we are in 2006, right? Sorry, I'll go to the previous slide. So from the market's point of view, if we are in 2006 and trying to value the stock based on the next 3-4 years of profit, which is what typically all research reports will stop at 2 or 3 years of projections. So let's assume you are an analyst and the market cap is about 80 crores. Sorry, profits are 80 crores. So you would have predicted 100 crores, 120 crores, 150 crores, that kind of a number of profits, right? So even if you total the market, the total profits for the next 4-5 years, it may be about 400 crores or 500 crores, right? So 500 crores is the value of the profits for the next 4-5 years. We are fine with that. But what is the market cap at that point in time? 80 crores is the profit. And at that point in time, sorry, the market cap was 3,700 crores. So let's say 4,000 crores. So the total of the profits of the next few years is 500 crores, whereas the total market cap today in 2006 was 4,000 crores, 3,700 crores, which means that almost 70% of the profits of the market cap of 3,700 crores could not be explained by the profits of the next 4-5 years. right? What the market is giving, that extra 3,000 crores or 3,200 crores out of 3,700 crores is the value of the profits that the market sees here, right? So the value of the profits beyond the fourth or fifth year is what is terminal value, and that is what determines the market cap in the longer term of a company, and that's what the market is looking at. So even in 2006, the market was saying that 500 crores is the next few years profits, but I'm giving a market cap of much higher than that because that's the value of the future profits. The terminal value investing is essentially trying to figure out what the value of the longer term profits is, and that basically brings us to the concept of gorilla investing, because stocks which kind of go into that approach. Yeah, stocks which basically do well, they become gorillas. And why we compare these stocks with gorillas is because if a stock is growing at 20-25% CAGR on on a base, it becomes very large, and these companies become large. If you look at gorillas, they are rare. Such stocks are not easy to find, so such stocks are also rare. They become dominant in their category. So dominant gorillas are the dominant monkeys in the jungle. Nobody tries to go close to gorillas. Even other monkeys try to avoid gorillas, and they are unchallenged, right? So this is what gorilla investing is all about, because stocks which have a high terminal value ultimately in the long term become gorilla companies. They are rare, they are dominant, and they become unchallenged. But most importantly, and this is the key to terminal value investing, it is the length of the runway of growth, the longevity of the growth path that determines high terminal value. So gorilla companies are companies where we are expecting a high rate of growth, but more importantly, we expect that that high rate of growth will continue for a long period of time, right? So they are rare, dominant, unchallenged companies, and they have a long runway of growth. And why we are saying it's again like a gorilla, because gorillas amongst all the monkeys have the longest lifespan. They are the longest living monkeys in the animal kingdom, right? So we try to find gorilla companies which are rare to find, which become dominant, unchallenged in the fields, but most importantly, they have a long runway of growth. So this is the chemistry, or this is the kind of magic of high growth investing, which is what we are calling gorilla investing. If you were to compare our style with the others, uh, there are some styles which are pure growth styles, which means that the only thing that matters is the near-term profit growth. So importance of growth. There are some styles which are very value biased, so try to buy cheap stocks, dividend yield, price to P, low PE, price to book, etc. Then there are some styles which are momentum players, so they basically are chasing the price momentum. Our style is growth investing, but with growth at reasonable valuations. And in valuations, we are using the terminal value prism to arrive at a good valuation of the company. What typically happens is that companies which are high growth companies, and the market believes that these companies are going to grow at a fast pace for very long periods of time, they tend to have a high terminal value. And as we saw in the example, 3,700 crores was the market cap, out of which 500 crores was near-term profits, but 3,200 is longer-term profit. So this, because the market cap is determined by terminal value, 3,700 by 80 crores is still about a PE of 25-30 or so, which is a typically you would say it's a higher PE. So the point is that such stocks typically will have higher PE optically in the shorter term, but they will tend to be, oh sorry, the PE almost 35, so to say 8 for the 32, or almost 45 PE. So such stocks will look optically expensive if you look at the next few years of profit, but you need to understand the market is actually paying importance to the terminal value, which is a longer term profit. So our prism of the growth investing is a little different compared to others. And when does high terminal value get created? Is basically the limb framework that we use: leadership, intangibles, and megatrends. Megatrends are, macro factors like demographics, changing lifestyles, rising savings, etc. So that I won't spend much time, but it's basically the intrinsic leadership quality in a company which creates a gorilla essentially. So the quality of management, the vision of the management, the execution excellence, the customer, connect, which is a part of intangibles, IPRs, a part of intangibles. So when leadership, intangibles, and megatrends, three things come together, that creates the magic of high terminal value. So these are some of the characteristics that we look at. When you talk about leadership, you are talking about hunger for growth. In my view, hunger for growth is the biggest driver for a company. Depth and integrity, excellence, resilience, and adaptability to changing circumstances. Because in a company's life cycle of 10, 20, 30 years, there'll be many pluses and minuses. And it's basically your capacity and ability to adapt and be resilient, which will determine your longevity of growth. Profitability, scalability, durability. Intangibles, soft assets like technology, IPR, brand equity, customer engagement, loyalty. And in these days, intangibles are far more important than physical assets. And megatrends we talked about, megatrends for India, for example, are the 70s: democracy, demographics, deregulation, digitization, dynamism. So when leadership, intangibles, and megatrends, these three to come together, they create high terminal value and they create the gorilla companies that we are talking about. So, that's a little bit of, our style, I would say. When we talk about trust mutual fund, there are a few other things that you kind of can expect from us. So we create a portfolio of about 40 to 60 stocks typically. And these are using basically qualitative and quantitative filters. So there are about 5,000 listed stocks, out of which about 1,100 stocks have a market cap of more than 2,000 crores. Uh, out of these 1,100 stocks, in our view, there are 600 stocks which we have filtered as per the sub industry and industry. There are about 600 stocks which we believe have potentially higher growth compared to the rest of the market. So, these are basically sub segments like pharma or real estate or wealth management or asset management, auto ancillaries, etc. These are segments which will typically grow faster than the rest of the GDP. So these 600 stocks out of 1,100 stocks are our focus areas. And then, of course, we have growth and quality filters like ROE, ROC, promoter, etc., moats, and all that. And that brings us down to about our universe of 250 stocks, which we monitor very closely. And out of those 250 stocks, using our final template of GARV and terminal investing, we try to find the best stocks out of those 250 stocks and create a portfolio of about 40 to 60 stocks. So in both our flexi cap fund as well as in the small cap fund, we have about 60 stocks in the portfolio. Uh, our portfolio management process is iterative. So we of course do fundamental analysis. Then we have very close approach of valuation, risk assessment, position sizing. So risk and position sizing kind of go together, and we construct the portfolio, and then there's a continuous review. And we review means you keep tab of news flows, keep testing the original investment thesis for each stock, continuous review of upsides and conviction, and then we also do attribution analysis to the portfolio. What to expect from us as our style? Typically, our portfolio will be 40 to 60 stocks. We avoid large cash holdings. We don't typically hold more than 10% of cash, even if we are not so bullish on the market. We will have a higher active share, which is basically a necessary condition for high alpha creation. You have to have a higher active share. Our approach to growth means that our expected portfolio average earnings growth is typically higher than the benchmark earnings growth, significantly higher. Maximum allocation, mid cap 3 to 5%, small cap is 2 to 4%. That's what we kind of aim for. This is more on the risk control side. We would avoid, bad, questionable histories and, poor corporate governance, of course. That's the qualitative aspect. We are basically trying to look at stocks which will generate or expected to generate good ROC on a. So it's not necessarily they should have historically higher ROC, but if the projections or the estimates are that they will do a good ROC, that would kind of, be our universe. The company should not have a history of poor internal cash generation. So 1 or 2 years is fine, but if consistently the company is not generating cash, then that's a amber flag for us. Modes, absolute obsolescence, etc. All those qualitative factors we look at. Most importantly, we don't buy optically cheap, mediocre growth companies. So for us, growth is of prime importance. So first, we test for growth. We want to see that the company is available at the company which is under consideration is a growth company for the next many years. So that's a prerequisite, and then we test for valuations. Of course, we avoid insane or euphoric valuations. We also are very actively holding on. We test our convictions, we test our thesis, and if the thesis is not holding out for 1, 2, 3, 4 quarters, then we exit the stock. So don't hold losers. We hold on to our winners, right to winners, and we pay very close importance to earnings upgrades and downgrades. For us, a consistent upgrade cycle or a consistent downgrade cycle is of paramount importance because that also determines the valuation of company. So this is what you should kind of expect from us. So that's a little bit from my side on our investment approach, our investment philosophy of gorilla investing, or what we can say terminal value investing. What I will do is now I will spend a little time just wrapping up the market situation. I think overall the global situation is kind of mixed bag. As far as India is concerned, kind of benign, I would say. Essentially, the US yields have been going up, of course. Recently, they have gone down in response to soft inflation data. But the uncertainty related to tariffs and US fiscal policy will keep the longer end sticky in the US market. So I don't expect the US 10-year bond and 30-year bond yields to go down meaningfully because there is a problem of supply demand. There is a lot of supply of US bonds which is coming up because of the deficits that they are running. And the fact that they're still not cutting down on the fiscal deficit. The other thing is that there is a wall of maturities coming up. There's a lot of US debt which was issued in the last 5 years, which is now maturing and that needs to be refinanced again. So almost from a run rate of $1 to $2 trillion, which was the run rate historically of every year bond issuance, the US will now have to issue $3 trillion of bonds every year for refinancing and all that. So, there's a lot of supply of US bonds out there in the market. That's the reason why we believe that the long bond yields in the US will not go down in a hurry. Eurozone and Japan economy kind of, mixed bag. Eurozone GDP is going down a bit. Japan is also in the doldrums. Even Japanese bond yields are going up. So the thing is that India versus the rest of the market, rest of the economies is looking very good. And the point is that central banks in the European Union have cut rates. So ECB has cut rates last week along with RBI. In other emerging markets also the rate cut cycle has begun. So I would say that financial conditions are getting easier because a lot of central banks are now going on to cutting rate cycle. India's GDP surprised on the upside, increased by 7.4%. led by lower subsidies payout and a sharp increase in government spending. And we were able to meet our fiscal targets even with good spending by the government in the month of February and March. GST revenues were strong. Industrial production was a little weak. So net, I would summarize it like this. Broad macro conditions in India are firming up. As I said, there's been a good spending by the government in the last 2-3 months. So if you remember the first out of, or I would say the June to December, the spending by the government was very weak because of elections and all that. But February, March, things have picked up. So that's also led to the GDP surprise. Inflation is good. CPI inflation is as low as 3.2%. We are almost like developed markets as far as inflation is concerned, staying well below the RBI's upper tolerance. Forex reserves climbed up to almost $700 billion. Manufacturing PMI is robust, signaling momentum. Decent earnings season for the March quarter, especially mid caps, very good results in the mid caps. May saw the highest monthly FPI flows in 8 months. So FPI foreigners are also back after selling for so many months. And the recent terrorist event and India's swift, decisive response has actually increased the confidence in the global community as far as India's capacity is concerned. In fact, a lot of our defense companies are starting to get orders from the global markets also. And the icing on the cake was the RBI, which provided an extra boost to growth sentiments with a sharp rate cut and CRR cut, clearly indicating a pro-growth stance. So overall, liquidity conditions, financial conditions are positive, and many central banks cutting rates. So their conditions are easy, and that is typically good for risk assets. So equities outlook is kind of positive because of that. If you look at our fund positioning, as far as our flexi cap fund is concerned, we are holding about 48, 49% in large caps. At the peak, it was about 58% in large caps. On the downside, it was about 40 odd percent in large caps. So we have been actively managing the kind of large cap, mid cap, small cap exposure in terms of stock picking. So what we are saying, what we typically do is we are market cap agnostic. So everything that we do is a function of bottom up stock selection. Of course, we do the sector allocation and all that, so that kind of adds to the alpha. But in general, we don't care whether the stock is large cap, mid cap, or small cap. We look at stock by stock opportunities, whether this stock is the one with the most potential upside in the next 1 year or so, and that's how we build a portfolio. So we are completely market cap agnostic. As of now, it happens to be 49% large cap, 30% mid cap, and 17% small cap. We have 59 stocks in the portfolio. As I said, we try to keep the portfolio to about 40 to 60 stocks. So it is close to that number against the benchmark of 500 stocks. Our industrials exposure continues to be overweight. We are 20% in industrials, almost 11% overweight. We are 35% in financial services, about 4% overweight. And within financial services, we have a lot of capital market linked stocks. We are underweight on both the consumption segments, FMCG as well as discretionary. FMCG is of course known. Discretionary includes automobiles. So we are kind of looking at the numbers. We like the stocks, but as of now, we are underweight because the urban economy has still not kind of shown resilience. So if you look at four-wheeler sales, etc., they are not still picking up to that extent. Otherwise, FMCG, we are negative. Discretionary consumer, we are negative. Utilities, we are negative because they are not very high growth segments. Energy and commodities, we tend to be negative because these are more globally linked in terms of their behavior. And the global economy is not doing that well. Commodities are soft, so we are kind of not taking too much exposure there. We got about 5% and almost 0% in utilities. So our stance basically is quite domestic facing. The sectors and stocks that we like are mostly domestic facing stocks and sectors. The top holdings, you can see, of course, the very top will be very known large caps, but then you have stocks like BEL, Coforge, Bharat Dynamics, BSE. Those are the mid and small cap exposures that we have in a significant way in the portfolio. So these are the top 20 holdings. If you look at the top mid cap and small cap holdings, this is names. And if you see consistently, all these names are high growth names. These are stocks which are expected to grow earnings at a rate significantly higher than the market. Performance has been good since inception. We have beaten the benchmark by about 2%. Small cap fund, similar characteristics. We are sticking true to label. We hardly have 2% exposure to large caps. Otherwise, most of the exposure is mid cap and small caps. 72% in small caps, 22% in mid caps. Top 20 holdings, again, quite significantly high growth names. These are the top mid caps and top small caps. You can see quite a few very interesting names. We still have the advantage of size. We are about 1,000 crores now in the small cap fund. So not too big. So we are able to kind of buy stocks which probably a very large fund would not be able to buy in a meaningful way. And here also the performance has been quite attractive. The direct plan is positive against the benchmark negative. Significant outperformance. So that's where we are on the fund positioning, etc. Happy to take any questions.
Thank you, Mihir. I'll share the questions. So the first question is on the markets. Do you think the markets are overvalued? And are you expecting a correction to stabilize that? Is it a good time to do a lump sum investment?
The markets are not overvalued. As I said, result season has been good. The Nifty earnings are expected to be about Nifty 500 earnings are expected to be about I would say about 12% or so. The P is at around 20, and this 12% I think next year will go back to 15 to 17%. So I think FY27 should be even better than FY26. So to that extent, overall, I think there is enough scope for stock picking in the market. Valuations are a little above the average, long-term average, but not too much above the average. So the market, by the way, has come to levels which were seen about 6 months back, which means that there has been a time correction. And within that time correction, we have seen 3-4 quarters of results also. So those earnings have come. So even at the same level, the PE of the market is lower than what it was 6 to 9 months ago. So markets are, I don't think, overvalued at this point in time.
So there's a question which I guess is for our small cap fund. It says that our small cap PE is the highest in the industry.
Yes.
What is your explanation for that?
Sure. So as I said, I think I said in the beginning, that's a part of our inherent style, which is terminal value investing, and that that basically is in stocks where we believe that the runway of high growth is very long. And as I said, optically, because of that, the terminal value is very high, which means that if you look at the next 1 or 2 or 3 years of profits, there will be a small portion compared to the overall market cap, which means that the PE of the stock on next year profits or this year profits will look high because of the high terminal value. It should also be noted that if you look at the next 2 years or so, our earnings growth of the portfolio is also amongst the highest, right? So I would say our peg for the PE to G portfolio of the portfolio would not be too high, would be maybe 1.
Thank you, Nishan, for the compliment. You can find the presentation on our website in the download section. Our entire process is stated in the presentation. There is a question stating that normally RBI rate cut favor the growth strategy in mutual funds. However, trust funds have shown high beta while the fall. Why do you think that has happened?
That typically happens because we did too well till December, January. I think at one point in time we were beating the index by more than 12 or 13%. And typically when the markets correct, the best performing stocks also tend to correct a bit more. And it's not possible to take a U-turn on everything and book profits and get out of them. So I think it's again a function of the investment approach. And while we did shuffle the portfolio significantly in terms of profit booking, etc., it's not possible to do the whole thing, the whole portfolio, do it to the whole portfolio. Having said that, on the upturn also we've done well and we kind of regained the performance. So I think it's basically the style.
There are some questions on
Because
overall expectation.
if you're a high beta, if you're producing alpha in an upturn, which means that your beta is typically higher. So that higher beta will show in the downturn also typically.
So there are some questions on the earning expectation on FY26. You partly already answered that. You want to add anything on that, especially on the mid and the small?
So in general, if I look at the index level, the Nifty 50 earnings will be single digit growth. The mid cap index and small cap index will be probably 15 to 20% growth. So the earnings growth as of now looks better in the mid cap and small cap portion.
Will US having a good deal with China impact India negatively?
I don't think so. I mean, the US problem with China is not good in the short term for anybody. So I don't think there's any issue with India, frankly. It's not like people have taken money out of China and put it to India and they'll do the other way around. I don't think so.
There's a question for the NFO. We are doing an NFO, sir. We've launched the multi-cap NFO in the form 30th of June. It will close on the 14th of July. This one, as I said, is multi-cap. That will be followed either by a large mid or a mid-cap. We'll get back to you on that. Please share some more info on the US debt situation.
Okay, that's an interesting question. Actually, I do have a few slides on that. Maybe I'll share my screen. Yeah, first of all, as you can see, there is a clear divergence of bond yields rather. So in the last few months, the US 10-year bond yield has gone up, right? So has the Japanese bond yield. In the same time, the German bond yield has gone down, and so has India, Thailand, China. So it's typically the other way around. Typically, they are all correlated. When developed market bond yields go up, the emerging markets also follow. But this is not happening for the first time. For the first time, we are actually doing much better. The emerging markets are doing better than developed markets bonds. So that's one very funny thing that is happening this time. Second is yeah, you can see this is the divergence basically. So Indian or emerging market bond have done well going up. Means not the yields. This is the price. So prices have gone up while the developed market actually has gone down or stayed flat. Yeah, this is the problem. The problem is that the US is still running a trade deficit and a fiscal deficit, which is still not, which is worse than or as bad as it was during COVID times, right? So this is the trade deficit. So if you look at the year by year, it's only worsening, the trade deficit. And this is the fiscal deficit. This is pre-COVID fiscal deficit. This is 1 year you can understand, 2 years you can understand because of COVID. But after that, only for 1 year they improved it, and again they are deteriorating. And this is like 6%. 6% to countries like emerging markets do. Developed market deficits are normally not more than 2-3%, and they were less than 2%, 2 to 3, 4% here all the time. Only time again the increase was during the global financial crisis. So ये level of fiscal deficit only was there during the crisis time. So which means they have been kind of completely irresponsible in terms of fiscal deficit. And even the new budget that is proposed does not give any comfort. They are still proposing a higher deficit only. So trade deficit, fiscal deficit, it's a recipe for disaster. That's why the dollar is weakening. This is the US Federal Reserve balance sheet. So while the Fed has been kind of Fed exploded its balance sheet, so from 4 trillion to 9 trillion, and this is the kind of stimulus which was not even done during the global financial crisis. And after that, thoda reduction hua hai, but it's still way above, and this is not being held by the Fed, by the deficit. So while the Fed is correcting a bit, the fiscal deficit is still out of control. The trade deficit is still out of control. And this is the one I was talking about, historically, this is the expected issuance of US bonds every year, this slide. So and this is 2025, this is 25, this is 26, 27, so on and so forth. Typically, every year, the US bond issuance used to be 1 to 1.5 trillion, this level. For many years in the past, this was the level of bond issuance. Because they funded the fiscal deficit by issuing more bonds from 2020 onwards, and those bonds were 3 to 7 years maturity. All those maturities are coming here now. So this is 25, 26, 27, 28. So from 1 to 1.5 trillion dollar of issuance every year, we are talking about 3 to 3.5 trillion of issuances. So this is the problem. This is why US bond yields are not going down, because the world can see that that there is going to be a huge amount of issuance of US bonds. That's why the 10-year and 30-year bond yields are not going down.
Sir, Amit wants to know how are we managing to cover 250 stocks with our current size, the team size on the fund
Uh,
side.
So we have 5 analysts, 2 fund managers, so 7 of us on the equity side, and then another 5 on the fixed income side. But I think for 2 funds, that's a good enough team. In my previous company also, we had a little bigger team size, but the corpus was 1,30,000 crores. So I think having more analysts beyond a point is not necessary, and if necessary, we are open to hiring more. But we have a lot of support from the sell side, investment banks, external research. So as of now, I don't think it's a problem.
What's the churn ratio of small and flexi cap fund?
Our portfolio turnover tends to be a bit higher because of the fact that we only want to restrict ourselves to about 60 stocks. So last month, for example, we would have entered and exited 12, 13 stocks in both the portfolios. That creates turnover. So annualized turnover would be, I think, more than 150% if you look at the gross turnover.
Do you expect RBI to cut rates further?
Uh, I think so. Maybe one more rate cut can be happening, though RBI has indicated, a pause kind of a thing. But if things are okay globally and inflation is under control, I don't see any reason, because RBI itself is projecting inflation at 3.5 to 3.7%. Right? So with that, you can cut rate by 50 basis points if you want to after 6 months or 12 months.
Is it a good time to do lump sum investments?
Definitely, I would say so. Again, depending on your circumstances and existing exposure. But as I said, I don't think the market is expensive at this point in time.
So the last question is, what's your thoughts on the BRIC currency?
BRIC currency, I don't have a view, frankly speaking. All I know is that the dollar will weaken against everything else, which means against gold, against silver, against rupee. Maybe I'm not sure against the euro, not very sure against the euro, but definitely against the Indian or the Chinese currency, it should weaken.
So the question is, are we planning an income plus arbitrage fund? We will be doing the arbitrage fund, and post that we take a call on the income plus arbitrage. I think that's about it. Anyone else has a question? Please post it now. Thank you, Rambo. Yes, our small cap fund has crossed 100 crores, and it's been a very short period. So we're very excited and happy. And thank you for the support of all the MFDs.
All the funds are now more than 1,000 crores.
I don't think there are any more questions, Mihir. Any closing remark that you want to make?
No, look forward to your support in the existing funds as well as, of course, in the upcoming NFO. And I will be traveling a lot, so I'm sure we'll meet some of you on the road shows.
Thank you, sir. Thank you, everyone, for joining in.
Thank you.
Bye.
Thank you. Bye.